Amid the excitement over cryptocurrency innovations, central banks are developing their own versions, such as a CBDC. This will help achieve high-level goals for monetary policy and provide private sector services that are secure and reliable. Cashless payments, digital banking, cryptocurrencies, and other new financial technologies will change the way we use money. But what will it look like? Cashless payments. The idea of a cashless world may sound appealing for many consumers and businesses. After all, electronic payment methods like card payments and mobile apps can make the checkout process easier and faster. Plus, they're often more secure than paper money. The global economy is already moving toward a cashless future, with many countries reducing their use of physical currency. However, the prospect of a cashless world is not without its challenges. For starters, many people still prefer the privacy offered by cash. This is especially true for younger generations who have grown up with digital technologies. In addition, some groups of people, such as low-income shoppers and the elderly, would be excluded from the benefits of a cashless society. Despite these obstacles, it's likely that cash will continue to decline in the coming years. Its use has dropped in several markets, and analysts predict that it will make up less than 20% of point-of-sale transactions by 2024. Additionally, the technological infrastructure that supports cashless payments is rapidly evolving. There are new front-end and back-end payment systems that allow for instant payments, bill payments, and request-to-pay functionality. Plus, there are buy now, pay later firms and central bank digital currencies that provide alternative options for consumers and businesses. However, it's worth noting that a cashless world is not necessarily safer than one with cash. After all, natural disasters or large-scale cyber attacks could render payment systems useless, leaving people unable to purchase the things they need. Also, the reliance on decades-old IT systems increases the risk of glitches and errors that can leave people without access to their funds. The move towards a cashless future will require careful planning by businesses and governments. These entities need to ensure that they are providing robust and inclusive financial services for all segments of the population. In addition, they need to offer a mix of digital and physical payments to cater to individual preferences and circumstances. Digital banking. Digital banking refers to the various financial services available online from a bank's digital platform. These range from depositing checks or cash to moving money between accounts, settling bills, and more. Most banks have already introduced a number of features on their digital platforms that make it easier to manage one's finances. For example, many banks now offer automated savings tools and send reminders on bills due. Additionally, the majority of a customer's correspondence with their bank is done via email or phone, which cuts down on paperwork. For the future, it is likely that the digitization of banking services will continue to expand. This will not only reduce operational costs for banks, but also create more opportunities to develop services that meet consumer needs. For example, a digital bank might offer a mobile payment app that can be used to pay for products and services, or a platform to help businesses manage their accounting and cash flow. The development of these types of services will increase the demand for digital currency and payments, which in turn will lead to an increased need for cybersecurity. To address these challenges, governments and regulators will need to focus on fostering beneficial innovation, as well as working with industry players to manage risks. This will require expanding monitoring horizons and reassessing regulatory perimeters as the embedding of financial services blurs their boundaries. In addition, the rise of digital money will increase gross capital flows as investors seek safe and liquid alternatives to foreign currencies. This may have negative implications for the global financial system, as it could lead to exchange rate volatility and imbalances in liquidity and market making, as well as increasing the risk of financial contagion. The future of money and payments can take radically different directions depending on the forms of money that gain scale, the technology designs issuers choose and use cases they target, how incentives are embedded, and how regulations and policies are designed, among other factors. The four paradigms below can serve as a framework for thinking about these possibilities. Cryptocurrencies. Cryptocurrency has captivated millions of consumers. What was once understood only by a fringe community of anti-establishment investors is now a household name, and it's growing quickly. But the phenomenon is replete with paradoxes. It draws users who are both pro and against regulation. It has an eco-conscious ethos, and it often relies on unregulated intermediaries that pose financial risks. These contradictions are a reminder that, while digital currencies can deliver powerful consumer benefits, they should be used with caution. Ultimately, only a system based on central bank money can be trusted to provide the foundations of a future monetary system that is stable and interoperable, domestically and across borders. As central banks look ahead, they are exploring new frontiers of innovation in money and payments, opening up vistas of a future digital monetary system that adapts continuously to serve the public interest. This vision entails three measured approaches. 1. True stablecoins that seek to import the credibility of sovereign fiat currencies. 2. Demand coins, which are demand deposits against insured commercial banks on blockchain rails. And 3. Central bank digital currency, CBDC, which would be cash on digital rails backed by central bank-issued liabilities. The pervasiveness of stablecoins shows how desperate the crypto sector is to find a nominal anchor. It reflects the fact that, unlike traditional money, cryptocurrency lacks a core function that serves society's coordination needs. Money has the power to impose order on the economy, and its strong network effects drive it into one form or another. CBDCs could be an important step in this direction, allowing central banks to play a key role in financing the real economy without taking on the risk of funding asset bubbles and housing bubbles. They could also provide a safe haven for consumers whose savings and investments are vulnerable to losses in speculative markets or who face credit constraints. The monetary system of the future will be built on a tried and trusted division between central banks, which provide the foundations of the monetary system, and private sector PSPs that conduct customer-facing activities. This architecture will be enhanced by standards such as application programming interfaces (APIs) that greatly enhance interoperability and associated network effects, and by technological capabilities embracing programmability, composability, and tokenization. Central bank digital currency. Despite the COVID-19 pandemic's challenges, consumers and businesses continue to shift away from cash. Plummeting cash usage and rapid development of cryptocurrencies have encouraged central banks to look into ways to leverage digital technology to offer an advanced form of their national currency. CBDCs, central bank digital currencies, are government-backed digital forms of money that have the full backing of the central bank that issued them. This differentiates them from cryptocurrencies, which are privately issued and not backed by any central authority. While cryptocurrencies are growing in popularity and value, most governments have banned their use or sought to restrict their growth. This is partly due to the volatility and risk associated with these assets, but also because there are concerns about their security, such as the ease of hacking. The Federal Reserve and other central banks are experimenting with CBDCs. These experiments enrich policy discussions by providing hands-on experience with the opportunities and risks of these technologies. McKinsey's research finds that CBDCs may be able to increase efficiency, convenience, and safety in the payment system by offering an alternative to commercial bank accounts and physical cash. They would make it possible to pay directly to a merchant without a third party or central bank intermediary, and could improve access to the financial system for those who lack bank accounts. However, there are also significant challenges to CBDCs. These include the need to verify identities, limit the amount of money that can be held, and provide privacy protections. Additionally, many of these technologies are relatively new, so it is not clear whether they can deliver the benefits that are being touted. Despite the challenges, CBDCs have the potential to be a major disruption in the world of money. In the future, they may replace commercial bank accounts and physical cash, and could even give a boost to the adoption of mobile payment apps. As the broader world moves closer to a cashless society, these innovations will have profound implications for consumers, businesses, and central banks. To explore these issues, on September 13th, the Hutchins Center hosted a virtual conversation between Prasad and Brookings Glenn Hutchins.